This meeting is being recorded.
All right, I think I am gonna go ahead and get going, and as folks come on, they'll come on. So I want to welcome everybody. My name is Rob Del Mastro. I am with the Small Business Development Center at Clark University. So just a little quick thing about the Small Business Center. Our mission is really to support, advise, educate, and inspire small businesses. We are advisors, and everything we do is for free. We are government funded, and like I said, our mission is to support small businesses, kind of in all dimensions of their business, from helping folks start their business all the way to selling their business. So welcome. We have Sarah on the line. Sarah is with me at the Small Business Center. She'll kind of be our moderator today. If you have questions, she'll be fielding those and interrupting Kim to get your questions in. We ask everyone to please be interactive. There's some questions that Kim are going to ask in the beginning, and it's important that everyone kind of respond, chip in, and let us know where you are with things so we can kind of tailor the meeting to your needs. And so let me introduce Kim. So Kim and I have known each other for many years. We're part of a networking group with the Worcester Chamber. Kim's got over 20 years of experience in the home financing profession, and I know she won't tell you, but she's won a bunch of awards for what she's done. It's a pleasure to have her here today. She is an entrepreneur herself, so she does understand some of the stuff that you guys are going through. So without further ado, I am going to turn it over to Kim.
Good morning. Thank you, Rob. It's truly my pleasure to be here, and I want to thank you and Sarah for having me. I'm very excited to be here, and I really, really admire the work that you do with Clark, the Small Business Development Center. So thank you for the center for having me and giving me an opportunity to share this information. It is a challenge, and credit is probably one of the hottest topics today, regardless of whether or not people need to borrow any money or start a business. It's everywhere you go. So learning more about the behind the scenes stuff and credit decisions, if it helps anybody improve their credit or get the financing they need, then we've accomplished what we want to today. So thank you. Just a little bit about me. Let me see if my space bar will work. All right, we'll just use the next button.
One of them will work.
There it goes. Watch, now it'll jump ahead 5 screens. Okay, so a little bit of my background. I've been a mortgage loan officer for 20 years. During that 20 years, I've had the pleasure of being in all of the areas of lending. So broker, banker, credit union, direct lender, and also servicer. And as a servicer, that's one of the characteristics that a lot of lenders do not have. They don't see the servicing side, and that's where you see a big difference with credit. During that time, Rob, thank you for that. I have been recognized for top producing, which means I see a lot of credit. I joined Bay Equity in May, and since then I've been top 5 in New England twice. Prior to that, I got my bachelor's right at Worcester State College. It was called then. Now it's Worcester State University. I drove by it the other day. What a difference. And I spent about 10 years traveling the country, opening up offices and businesses for a couple of different industries, which launched me into my own business back in a long time ago, the 90s, where I started from the ground up individually, going door to door. And I expanded my own business into 6 different large markets up and down the East Coast. So I also had that experience as an entrepreneur prior and understand what it's like to try to be launching and starting a business and being on your own trying to do it. From that, they did hire me as a national liaison, and I took my knowledge from opening those businesses around the country. And when all of that was done, that's when I went into lending about 20 years ago. So really important. I want to make sure we get out of this class. We have a nice blank slate here at the beginning of the class or workshop. And so I think one of the number one things I really want to know is what interests you about this topic. And I know it's very early on in the class, and but I do welcome some feedback on what you're looking to gain out of this class. I do like to make sure you're walking away feeling as if you've got some valuable information that will help you going forward. So what interests you about this topic? And I'm happy to have, it's up to Sarah, as far as opening up a verbal question or the chat, whichever is most productive.
Yeah, whatever you guys are more comfortable with. You can either put your question in the chat or there's a raise your hand button and then we can call on you. We promise we don't bite.
I see James with his hand up.
Go ahead, James.
Sorry, I can't even see James. Thank you.
We've got to unmute. There we go. Hi, everybody. Thank you for this. Just my personal situation. I'm a musician, and that's not been a good thing through this COVID time. All work as I knew it stopped 2 years ago. I've tried to reinvent myself. Last summer, all credit cards were paid off, and I have now run up. I'm kind of living on credit cards lately. I'm trying to do a lot of other entrepreneurial things, and I expect I'll make money. But I've just watched my credit rating drop from, I don't know, 700, 725 or something to low 600. It's dropped 100 points it's amazing to watch how, you finance one thing and your credit rating drops in days. Like, I thought maybe they watched it month to month, but I've come to see that your credit rating responds very fast to that. And I'm bombarded now by offers offers for loans and things like that. Things I've never heard of before. Loan companies, and now credit card payoff loans and things like that. So there's my situation, and I'm interested. One other thing. I'm hoping to use my VA loan that I've never used to buy a house. And my credit rating just dropped below what they will approve.
Okay. Those are all.
So hope you can talk about that stuff.
So first, I'd like to thank you very much for your service, and I hope you don't mind me saying that. I understand when I do say that, I get a little bit of mixed responses, but I do very much appreciate the service. I'm actually the daughter of former military myself. So I do appreciate that.
Thank you. It was before you were born.
So those are all very interesting topics, and I think that your experience is not unlike several people's experiences, especially over the last 2 years, coming up on 2 years in March here, is I believe when COVID really came into full swing. So your experience is not that much different, and we will definitely tackle that. What I heard is that the credit score has really changed as your credit, how you've used your credit and paid your credit has changed. And that's not a positive or a negative. It's showing that your credit score really was dramatically affected by the way you were using the credit, paying it off. And that's not a bad thing. It's a computer program, and we will definitely talk about that. And then as far as getting yes, you raised your hand.
I mentioned one more thing, just defensively. I've paid everything on time, so I'm not, and not in trouble. Credit card companies are happy to loan you the money,
Yeah.
And all of that. But it's amazing how what's the word, your profile changes from, you know, whatever, good person to bad person by putting some thousands of dollars on credit cards.
Yes, I completely understand. And we will talk about doing everything right, or, you know, following what you believe to be right and it's still not working. So we will talk about that, and hopefully the information that I have will help restore that credit. I did actually have a slide in here about your credit score and confidence. So I did take the slide out, but I will try to touch on that when we get to that part of the presentation. So thank you so much for bringing that up. And then we will also talk about the getting offers with the internet today. That is rampant. In fact, when I was working with Rob to do the presentation, I said, oh, I think I've been cookied because so many things were popping up. So thank you, Jim. We will talk about that. And as far as the VA loan goes, I would be very happy to have a sidebar with you about a VA loan and credit requirements, because there are some guidelines versus policies. And it's more about a credit profile, which we will also talk about, minimum credit scores versus credit profile, as far as qualifying for a VA loan or any loan. Does anybody else have anything they'd like to add about what interests them about the topic? Are there any chats or hands? No? Okay, I'm getting it. All right, next. What do you hope to get out of this class? So there's interests, and then there's hope as far as what you'd really like to walk away with. How can this class help you? What do you hope to gain? And this I'd also like to open up for either verbal or chat questions or content, if anybody has anything.
Come on, folks, don't be bashful. Makes for a much more lively couple hours.
I will self-disclose that I'm painfully shy, so if I can do this class, I'm sure there's some questions out there that can be asked.
I think, Abe, do you have a question?
Well, yeah, I just, you know, I've been trying to get a small business off the ground for the last 3 years, and I'm looking at an SBA loan to acquire another business. And we're closing on a house tomorrow, and I had some complicated medical problems, and I had a $30 copay went to collections. It's showing up on my credit report right before we're closing on a house, which I paid promptly. And so I'm just hoping to kind of figure out how to sort of navigate these complicated algorithms.
Okay. So you have some movement on your credit profile, some activity, and things are showing up that you didn't expect. And now you're looking for future lending options, maybe mostly commercial, small business. Yeah,
and then just trying to figure out what to do with the medical collections. I didn't think that in Massachusetts medical bills could go to, you know, could show up on your credit report. So that surprised me. For a $30 copay that I offered to pay when I was in the office.
Oh my goodness. Okay, so you want to tackle things that go to collection, medical in particular. We will talk about that. And then getting a small business loan. Great. Thank you so much. Yes, we will talk about that, Abe. And thank you so much for contributing.
It looks like Vanessa has her hand up. Vanessa, do you want to unmute? There you go.
Yes, hi everyone. My question is, why sometimes when you have a house, right? And then when you're trying to get a loan, personal loan, or for a personal loan, or a loan for a business, and then they say like your credit is not like improved as much to get qualified to have a business loan or to have a personal loan.
So just to make sure I understand that, so are they saying that you don't have enough credit or a minimum credit, or
no,
what is it?
you have the minimum credit. Let's say they require like to have 680 or 620. The requirement is okay, but they say like you don't prove like you have that much debt or that much debt to get qualified for the personal loan or for the business loan, even you have a house and equity on the house.
Okay, so it looks like what they're talking about is either your credit profile as a whole or your credit history and the length of your credit history and how that is going to impact whether or not they'll extend more credit to you. So that's what it sounds like. If I'm hearing that right, does that seem to sound relative to what you're mentioning?
Yes.
Okay,
Right.
great. So yeah, so that is when they pool your whole credit profile together. They're thinking about giving you money for whatever the project might be. It can be called your credit history or your complete credit profile. And there are guidelines and requirements and evaluations that take place when they're looking at extending that stuff. And we will touch on it for sure. Definitely on the personal side of it, but a lot of the personal side of it does also relate to the business. And I do have a slide in here that has the pivot between the difference between personal finance and commercial finance or small business finance. So Rob, if you can just ping me when we get to that slide, it's got two pictures, commercial and personal. And if we have to expand on that, I'm more than happy to do that. I have done commercial lending as well, primarily in the residential district, but many of the commercial residential lending requirements are very similar to a small business lending requirement. So we can talk about that a little bit more when we get to that slide. I'm happy to add more of that in, given the dynamic of the questions here.
All right, thank you.
Yeah, thank you very much, Vanessa. I did
Just
see
quickly,
Sasha.
Kim, it just looks like Sasha and Riaz put in the chat, they're looking to learn how they can build up their credit for their business. That's
All
what
right,
they're on here for.
Great, and tips on how to gain credit as a new business. Perfect. Great. And Riaz and Sacha, is it Sacha or Sasha? I will be more than happy to talk about those things as far as building credit goes. A lot of times it does start with building your personal credit. So I do have a big emphasis on personal credit. Generally speaking, how you've managed your personal credit is going to help in some way, or the way it's viewed in lending, somewhat predict how you'd manage your business credit. And so your personal credit is evaluated even when you're looking to get to a commercial or business credit situation. So getting that personal profile as strong as you can possibly imagine, when they look at that and they see that you've managed that credit in a guideline algorithm sort of way that it's positive, that's going to help get that small business credit started because they see a history of a strong credit profile. So yes, we will tackle all of those things. And thank you. That's great content. And just before I go to the next thing, is there any other, anything else? Any other questions before we go ahead? Oh, my space bar is not bringing up the bubble here. I'll just go to the next slide.
We have one more. Allie just mentioned in the chat, she's focused on rebuilding her personal credit after facing a layoff a few years ago. Her credit dramatically dropped, but efforts to restore are taking much slower than how it felt, which I think is what Jim was talking about earlier. So it looks like she's trying to build back her credit.
Okay, great. Yes, rebuilding credit. We will definitely talk about that. I'm going to ask everybody to grab a pen and a paper. You don't have to share anything. It's all personal preference, how much you want to get out of the class and how much you want to put into it. So grab a pen and a paper when we get to that section, and we can do some math. You can keep your personal data and use your personal data to do the little formulas that I'm going to share. Okay. Whoops. Hang on one sec. Yep. Okay. So I think we got quite a few questions out of the way. I always like to give multiple opportunities. Sometimes when you ask a question a different way, you get a different answer, even though it's the same question. I think we've got a bunch of questions we want to tackle. I've got some notes here. Did anybody else have anything else? A simple question about credit, building your credit, and lending. Okie dokie. Any myths? Anybody hear something out there they weren't sure was true, not believable, believable? Followed the myth and found it didn't work? Lots of myths out there right now. Misinformation, myth information. That's what I call it. Okay. So what I'd like to be able to deliver in the workshop here is a better understanding of credit scores, how to manage them, and the impact that the credit can have on your ability to borrow or gain access to money. If you're trying to start a business, you almost always need capital to do that in today's world. And if you're not made of capital or have a rich uncle or aunt or a family member, you oftentimes need to borrow it. And before you can borrow it, you have to have a profile that they can look at in order to give you that money. So what I'm hoping we get out of this class is a very enriching class that brings you a better understanding of your credit scores, why they are what they are, how to manage them, which includes, Vanessa, rebuilding that credit and anybody else who had that question. And then also how it can impact the ability to access that money that other people have and may give it to you based on all this information.
Right.
Okay, so first things first, what is a FICO score? Has anybody heard the word FICO? You can just raise your hand and say, yup, don't know what it is. Oh, they told me that. I still don't know what it is. So a FICO score is a 3-digit number which represents information from your credit data history that's been recorded, meaning it got captured by a credit reporter. It helps lenders, they're the ones who have the money, determine how likely you are to repay a loan or a line of credit or any credit. This in turn, that credit score can dictate, which means it's going to affect if you can get any of that money from that other entity or how much they might give you, and what's called the terms and the conditions of that loan, meaning how long are they going to give you to pay them back? How much are they going to charge you to give you that money, your interest rate? And if they need to charge you any fees to process all of that information so that they can make a decision on whether or not they're going to give you any of that money. So before you do anything, the FICO score or your credit score is what they're going to look at first. So if you ever call and you say, hey, I'd like to borrow credit, I'd like to get some money, the first thing they're going to ask you is, can we pull your credit?
And a quarter by 46 and a quarter. Okay, gotcha. Okay, that's 913.
All right. Now, where did the FICO score come from? Nobody knows this. Nobody knows this. All right. It came from Fair Isaacs Corporation. So FICO. It was actually only founded in 1956. And it's basically algorithms. It's a computer math program. not a human being. There's no emotion, doesn't really care. They put a bunch of information in, they get a bunch of information out, and the program that they use to do that is called an algorithm. I brought this in because I thought it was very interesting because Bill Fair, you would think Fair Isaac meant something like, oh, this is a fair evaluation of credit. We don't know who Isaac is. That's not true. It's a guy named Bill Fair. And he was an engineer. And while he was at school at Stanford, he ran into Earl Isaac, who was a mathematician. They both had $400 in their pocket, which is what they contributed. So they had a total investment of $800 back in 1956, and they began the Fair Isaacs Corporation. And I wanted to include that today because I find it very interesting that we are here at the Small Business Development Center, and Fair Isaacs was a very small business, and that's where it got its start. Okay, what they then did is they created algorithms which they sold to the 3 credit bureaus. So these are the 3 credit bureaus. Now, the oldest, greatest, grandest, and also the one with one of the more difficult algorithms is Equifax, which was established in 1899. It's an oldie. Then came along TransUnion in 1968, and Experian in 1996. So it's very, a lot of people think this has been around a long time and we just have the access now. It actually isn't. Equifax was really the old dog out there. No offense with that type of statement, but that's the oldest one. It predates Fair Isaac. But everybody else pretty much, TransUnion predates it as well. And then Experian's the latecomer to the game. But the 3 bureaus each purchased their own individual algorithm from Fair Isaac, from FICO, which is why whenever you look up your credit scores, you hear a variety of things. You think, the credit scores aren't matching, and that's correct. They don't match because it's not the same computer program and they're not the same company. The other thing I want to note about this is that the credit bureaus, are they government organizations? Are they nonprofits?
Probably not.
No, they're definitely not. All 3 credit bureaus are for-profit corporations or companies. So their goal is to make money. What they do is use those algorithms from the information that they get from your creditors. So if you have a car loan, they're reporting it. If bank, credit union, credit cards, they report it. The algorithms then go to that. That information goes to the credit bureaus, who then put it through their little computer, and it spits out a score based on scoring mechanisms that they've purchased from FICO. To this day, FICO is the predominant scoring method for all lending situations. And even if you're going to do commercial credit, we will touch on commercial credit in towards the end of the presentation. But at the end of the day, it always does come back to that personal credit and that personal profile, credit profile, to dictate the rest. 78% of Americans have a credit score through FICO. So that is still a very vast majority of people who have it. 12% don't have enough information for scoring. So this came up a little bit earlier. So there's information, there are credit lines, there are trade lines, you might have a loan or a car payment or a credit card, but not enough information is there yet to get a score. So that 12%, as long as they continue to develop and grow that profile, will move into that 78%. And so now you're talking, almost 90% of people have the ability to have a FICO score because of how much is reported to those bureaus. 10% of people in America, they have no credit bureau profile at all. These are off the grid. They are totally off the grid. So when they're going to get credit, that's the hardest part, because specifically with home financing, and this includes all types of home financing. So conventional and government, which is VA would fall into that, as well as FHA, USDA, mass housing, all of those programs, they all still use the FICO score for a scoring method. And with the population having as much as 90% having the ability to have it, that FICO still is the predominant and prevailing scoring mechanism that's used to get a loan. Some of the other scores that are starting to make an entrance into the market is your FICO expansion score. That's still not it. You don't hear it talked about it. I'm guessing this is probably even a new term to some people. Here they have not heard of it. The one you may have heard of is the Vantage Score. This was created in 2006, 2.0 in 2010, and there is a 3.0 that's starting to get out there on the web as well. Now, what is the Vantage Score? If you use Experian to track your credit, if you read the fine print, it may be a Vantage Score. It may not, but several times very recently, I've had conversations with people and our scores didn't match. And when we looked it up, it's the fine print, it was a Vantage Score. Now, what is the Vantage Score? The three bureaus have started working together to get their own scores. So they are not using Fair Isaac to get this score. It's the three bureaus working together. And this is just my take. So this, for what it's worth, I think they're trying to get away from the expense of the FICO, paying for FICO, by creating their own scoring mechanism. But as you can see, it's only about 10 or 11 years old. There's still not a lot of information out there. For us in lending, LexisNexis is a go-to because it captures far more information than just your credit score. LexisNexis is a tremendous reporting organization for a lot of things: rent, commercial, LLCs, DBAs. It captures a lot of that information and puts it into a system that lenders can then access to get a better picture of what your business profile might look like. They also capture corporate names, who's heads of corporate, commercial entity structures. It is a gigantic database to do research. So as a consumer, you don't really hear about it as much. As a lender, it's a go-to. It comes up every month in a transaction. And then the latest is the FICO Score XD. This is another FICO kind of spinoff. And again, brandy new, 2016. So you also may not hear about that much. But there are other mechanisms coming out there today. Now, that small 10%, just to touch on it, when you don't have a credit score, you can still sometimes get access to money. You can borrow. And that is if you've established a non-traditional credit history. So what's non-traditional credit? Well, we all pay for a roof over our heads, but it doesn't all get reported to the credit bureau. Some of us pay rent. You might be in a complex, you might have a landlord, you might have a family member, whoever it is that you're paying rent to. If it's not a mortgage or a financed transaction, that may not be getting reported, but it's definitely there. Utilities are another thing: heat, hot water, electricity, something that you're paying on regularly. Insuring your car, insuring your house, insuring your family. Tuition. So if you're going to one of those schools where you're not borrowing from a government or, the student loan, private loans, you may be paying tuition directly to the school on a budget plan. Well, the school may not be reporting that. Subscriptions. This is a big one today. We see this all over the place today, is subscriptions. So all of those apps, if you pay for the apps, all of your TV subscriptions, Hulu is one of those. That's something else that you're paying on a regular basis that's not being reported. And medical bills. You may have set up a payment plan on a medical bill. Maybe your deductible or your copay was really high, and at the time it wasn't, you didn't have the ability to pay that. The means is what we call it. So you might have set up a payment plan with that medical biller so that you could stay out of a collection situations but pay on it. Same thing with your daycare, you're paying for that regularly, and your cell phone's not reported as well. So the trick with non-traditional trade lines, this is a trick if you do not have a strong credit profile, but you're looking to grow your credit or improve your credit profile that you can report. If you're going to go for some type of loan or lending situation, generally speaking, it's a 12-month documented payment history of your non-traditional payments. So if you don't have a history and your credit profile may not be as strong as you'd like it to be or need it to be to get the money, you can start building your non-traditional credit profile. It's 12 months recorded payments. What does that mean? That means you pay it every month from the same exact account. Nobody else is contributing to that account. And so that you can go back and you can grab 12 months of canceled checks or 12 months of bill payers from your account only to that creditor. And then your creditor also provides you 12 months saying, yep, we got it and we got it on time and it was paid in full each month, or paid, the minimum due was paid each month on time. So the question about how do I establish credit if I don't currently have any, this is a non-traditional way that you can do this. It is time intensive, and if you haven't started doing it, you're about a year out from being able to use it. If you do pay things on time, and you do have a history, electronic is best, then you will be able to use it.
Hey, Kim,
yeah.
let me ask you a question on that. So let's just say I do have that 12 months worth of history. Who do I take it to? Do I go to one of the credit bureaus with that information?
That's a great question, Rob. Thank you. Depending on what you're looking to get, because it's about what are we going to get from this. So if you're looking to get something, you would take it directly to that creditor so that they could evaluate the trade line. From there, some creditors can actually assign it to your credit report.
Okay.
So you can get it added. You could also do it yourself through some of the things that are coming out today. You know, and I'll jump ahead a little bit, like Boost, or I reported my Netflix and my credit score went up, right? Okay, this is very cautionary about those things. Historically, if it's not appearing on your credit report, historically, so you're not gaining anything because it's not reporting. They don't continue to report unless you continue to report, because you officially just became the reporter, right? They're not then going to reach out to your landlord or something like that to get that. You have to continue to report it. The issue is, I foresee, because it's still very, very, very new, most recent few years. The issue is, in the past, creditors who don't report, this happens with those private loans you get at like a small auto dealership or something, the only time they report is when you hiccup. So you got no benefit of the build and all the hit of the decline when it gets reported. So you need to make sure if you are going to do this, you are on it. You got to stay consistent, stay on top of it. And it is there. Once it's there, it's very hard to take it off. So generally speaking, if the goal is to get money, take it to the creditor, not to the bureau.
Got it.
Generally.
Okay.
Did that answer the question?
It did. Yes. Thank you.
Fabulous. Any other questions about, I did see a question in the chat. It popped up and disappeared. So I want to make sure I don't miss it.
Yeah, I think Rob rephrased the question for her, and
oh, thank you, Rob. Okay. So I brought this slide back just to reiterate, you know, 3/4 of Americans do have the ability to get credit. The 12% who hang around, who continue to grow their credit, will also have credit. And the other thing that I did want to note after coming around on this is the right-hand side of the slide, very bottom box, one trade line at least 6 months old. If you can get a solid trade line for 6 months, consistent payments, and it's 6 payments. So if you got the credit line today, say in February, it's usually not going to report for about 60 to 90 days. So it's 6 months, but to us, it's going to be like 7, 8, maybe even 9 months, because the credit bureau may not report it for as many as 90 days. So really it's anywhere from 6 to 9 months to establish a FICO score. Okay. And this was the slide I jumped ahead on, current events trending, and this is the boosting your score. I did also want to talk about the apps and clicking. Whoa. I don't know what happened there.
Easy there, Kim.
I know my mouse got a little, was very excited about the presentation apparently. Okay, so current events trending in the market. Who's heard of the, and I have to be very careful because, I don't work for any of these organizations and I don't have anything against them. So let me just put that disclaimer out there. It's just what we see on the lending side. So all of these things out there, who I'm guessing at least 50, 60, maybe even 70% of the people on this, in this workshop have an app on their phone that somehow shares, credit information. They're either getting an alert or they're getting an advertisement or checking that app on their phone. Anybody do that? You see any hands? Yeah, I see a couple of hands. Yep, checking the app. Clicking the app. Have you found yourself getting an alert or getting something on the app, or you're just sitting there, waiting for something, scrolling your phone and something pops up and you click it? Who's clicking?
Nobody wants to admit that.
Nobody wants to admit it. We all do it. I do it. We all do it, right? Cookies, right? I loved cookies as a kid. They love me now. They follow me everywhere, right? You click on one thing on the internet and next thing you know, on the right-hand side of your screen, it's getting advertised over and over again. How do they know that? Well, that's an algorithm. And it's called cookies or tracking. Well, they are reporting. So there's a commercial out there that says, oh, honey, you shopped for a car online. Oh, don't do that. It's going to hurt your credit. Oh, it didn't hurt my credit. It will hurt your credit. So we're going to debunk that myth right there. So commercial saying, hey, it won't do that. They're having to do that because it's happening. So when you're clicking on that, they are reporting it. There's a couple of really big apps out there. I don't want to say anything by name, but there's probably the most predominant app out there, and I will touch on it later. It is popping up on people's phones all the time. It's the number one objection I get when I'm talking to people about their credit scores is this app telling them their credit score and it's not hurting them. And it's a self-inquiry, so their scores aren't going down, but that information is being reported. So when I get a credit report, an official credit report, I can actually see hundreds of taps on that app. So they are reporting it. The other thing that they are doing is your phone carries a ton of information. So does your laptop and your tablet. All of that information is also being captured, which is why you're getting all of those cookies and ads and offers for credit, because they are telling and selling that information in order to pay for the app. So if you're not paying for the app, somebody else is paying for the app. And the reason they're paying for it is because the app is selling your information to them for money so that you don't have to pay for the app. So you want to be very, very aware of apps that are free, that are providing any type of your credit information or advertising for credit. Just ask yourself, is this for profit or is this for service? And if you're not paying for it and you're getting a service, somebody is making money on it and they're getting it by selling all of your clicks. So be very aware of that. What you want to do is use your reliable, and I hate to say it, but brick and mortars, your brick and mortar bank, your brick and mortar credit union, someplace that you're going to where you're getting a service for the money that you have there. And that is your best bet to eliminate a lot of that stuff that's happening. And this ties into one of the questions we had earlier about offers for loans coming up everywhere. That's because your information is being shared. I generally advise people, if you're having that happen, unsubscribe and unauthorize and use reliable sources. And we will get into that in a little bit. Okay, so establishing your credit. Do I still have everybody? Okay, so what's good? What's not so good? And how to make it great. So nobody likes to hear they have bad credit. Nobody. If you heard that and it was upsetting, you're not the first, you won't be the last. That does not mean dismiss it. People associate their credit score with their level of confidence. But that, just because you have a credit score that's not where you want it to be, doesn't mean it's not going to get there. And it was a computer that spit out a number. It wasn't anything personal about it. I like to think of it as, if anybody's familiar with the old music boxes, there's a little wheel inside the music box with little ticks on it, like little bumps. And as the wheel spins in the music box, all of the little tines, they're called, click along that, and they make little bells and they make a little melody. And that wheel just spins and spins and spins, and those little tines just click away making music. That's pretty much what that computer is doing. It's not really having anything involved in it on information that was reported. It's just an algorithm. So when you move around things on your credit, subsequently, that number is going to move as well. Also, too, a lot of places will not say you have, some places won't say you have bad credit. What I like to relate it to is whether or not you can get a loan or you can get financing with the score and the credit profile that you have. So if you get below 640, and to be fair, it's really 620, 620 and below, that's when you're going to be in a category where commercially, definitely, but even personally, you may have some issues trying to get approved for some type of financing. Now, as far as home financing goes, because that's my predominant industry is home financing, mortgages, purchases, and refinances, there are actually loan programs out there that have no minimum credit score requirement. What they are looking at is your credit profile. The other part about that, though, is when you get in that range, the interest rate you might qualify for is obviously going to be higher because there's a lot more risk when there's been a credit history that's resulting in that score. When you get above 640, really to 699, you're in a range, excuse me, where personally, you may qualify for some a loan or some financing. You may have to do a little bit more work in order to show that you've got the character and capacity to pay that back, but you may get approved. But it's also, the rates are going to be a little bit higher, and you might have to do a little bit more work. They might want to verify a little bit more information. When you get above 700, 700 really is the benchmark. So the credit bureaus would have you believe you got to have an 800 credit score, else it's bad. In lending, that's not really the case. We very rarely actually see 800 credit scores across the board from all three bureaus. So if you do have an 800 credit score, you have done a stellar, amazing job. Really in lending, 7 to 740, that's really where we see most of our clients and most of our credit when it comes in is between 7 and 740. And 7 is the benchmark. 700 is the benchmark. When you get to 700, that's when you're going to see a big improvement in things like the rate and the ability to get, approved. So the ability to get approved at 700 goes up greatly. So that really is the benchmark. And that's true for both personal and commercial. Yep. So commercially, almost always, you're going to have need to have established a 700 personal credit score to get those commercial loans. If you have a 700 credit score personally, and you need a residential loan or line of credit or credit card, you have a very strong chance you're going to be approved almost 100%. If you get above 740, this chart says 749. 740 is your top tier when it comes to residential lending. Above 740, you could have an 800 credit score. You're going to actually get the same interest rate as somebody with the 740 credit score. The rates kind of top out around 740 for your interest rates. I have another slide on this, but before I jump ahead, does anybody have any questions about this particular chart or slides? I'm not seeing anything. All right, Sarah's giving me the nod. We're going. So where are we in the United States? this is where the credit scores are trending in the United States. So back in 2008, which is when a lot of this really started being captured, it was also the burst of the residential real estate bubble. So I went back to this point to get this chart, 2008. And then of course, the bubble burst and we had really our first dip. And it took a little while to start getting it back up. We really started seeing it to climb around 16 and 17 to where we are today. We've actually just recorded 711 for our 2020, which is the highest average credit score we've ever had in all history. And I do attribute that to more and more people being aware of it, and people who were younger being aware of it at a younger age as well, because they're on their phones and they're seeing all this information. So even though there's a lot of apps out there that are reporting the information, they're paying more attention to it. And just that little bit of attention you pay to those credit scores and how you're managing your credit is resulting in higher credit scores across the board. And as far as how that affects your lending, I did a little bit of this earlier, but I thought this was a nice little graph that breaks down smaller categories of lending. And it really starts addressing things like the credits, the interest rate that you might qualify for based on your credit. So the higher the credit score, the lower the interest rate, usually around 740 and above, you're going to top out. Oh, and you know what? I do want to touch on one thing for James. A VA loan actually does not have a minimum credit score requirement. A bank or a lender may have a policy in place that says they won't lend below a certain number. So a VA loan does not have a minimum credit score requirement. What they have is a credit profile review. And as long as the credit profile is strong enough, and you get what's called an automated underwriting approval, another algorithm, another computer program, that loan can be written. If you went to an entity that said they couldn't write it because of a credit score, then they may have a policy in place. I see Riaz with a question.
So he wants to know, how do you know your commercial credit rating as compared to your personal credit rating?
That is a great question. So how do you know your commercial credit rating versus your personal?
Yes.
Correct.
Okay. So I'll tackle a little bit of it here, and it might come up a little bit later. I did put a commercial slide in here. So it is harder to get that commercial credit rating, and it oftentimes does come back to the personal credit rating. There are commercial grading entities out there. One of the most predominant is going to be Dun & Bradstreet. I've put a link in the presentation, and I can also share it in the chat if I can get it off my presentation, or I can send it out after the presentation if people want to, if people would approve sharing their emails so that I could, thank you for coming, or share information or open a line of communication. Dun & Bradstreet has several indexes for measuring your commercial credit. There's several. And it is harder to get. It's not like you can walk in and they're going to pull your credit report. Because what Dun & Bradstreet does is they break it down into subcategories as far as the commercial lending goes. So it is a little bit harder to get that grading. There's not really a commercial FICO score. As far as or a commercial, they don't buy anything from FICO. They don't buy anything else. It's really kind of their own mechanism for evaluating the credit. What you'll find out is when you apply for commercial credit, you want to be working with a loan officer, a commercial loan officer who's really willing to share with you what you need to get your loan approved. Because when you're looking at a commercial project or a commercial credit, yes, the commercial history is important, but the other part about getting commercial credit, and I'm jumping ahead a little bit here, so we'll save time later on that one because we'll cover it now, is commercial credit is based on the ability of that commercial endeavor to pay the money back that you're looking to borrow to have the commercial endeavor, to create that commercial endeavor. So regardless of your prior rating, even though you want a really strong one, the project that you're looking for the commercial loan or line of credit has to itself be sustainable to pay that commercial line or loan. And that's where it gets a little hairy, because that project that's why you have to submit so much stuff about the project and plans, so that they can have some confidence that that business enterprise is going to be able to pay for the money you're borrowing. I hope that answers the question. Oh, here's a follow-up question.
Yes, basically, I tried using Dun & Bradstreet because I am involved in the export business. So basically, to get a letter of credit, I needed to have a Dun & Bradstreet. So I went into it, I don't know, build your own credit kind of scheme or whatever, $1,500. And what I found is that even though I made a whole bunch of purchases and I performed, they would not record everything unless the purchase is from the US alone. Like I purchased something from Canada, they did not record. And then the second thing is, if you purchase anything from a non-Dun & Bradstreet company, they would not record that either. So in reality, everything I did was perfect, but I did not get any credit for it. So I just basically I canceled the subscription because it was not doing me any good. But that's where my question is that in order for me to grow, I need to build up my credit gradually. And Dun & Bradstreet doesn't do much to build up credit. They are basically, and even though I have nothing negative, I see the Dun & Bradstreet credit risk factor, they call it the risk factor, goes up, even though there's nothing negative in the record. It's like, because of COVID, the business was slow, so all the numbers are going down. That was my question, basically. I don't want to derail you, but I wanted to basically establish a credit for my company. My credit, personal credit rating is good, but I want to do something for the company.
Yeah, I completely understand. And it is, the commercial aspect is more of a challenge. Your situation is specialized probably to this group. And so I'm more than happy to set aside a time. Maybe we can connect on that. I don't know if Rob might be able to follow up as well with some information that might help to establish that. But that is correct. Dun & Bradstreet, they are a resource. Lenders do use them, but not necessarily. It kind of ties back to that. Is this for profit or is this for service? To try to create that. The other aspect is learning the calculations or formula, because as you increase your debt or you increase your borrowing, that can also affect your rating. And so if your rating, I don't know why a rating went up or down without seeing the profile, but what you do will almost always affect the rating. So learning whatever, what calculation they're looking for is really, the trick to building that credit. You have to kind of learn what it is that they're looking for. Is it a credit history? Is it an amount of credit? Is it getting it but not using it? Those types of things. And we're actually going to tackle that stuff personally next, and hopefully some of it will apply to your question on the commercial side.
Yeah, that's fine. We can do a sidebar on it later, or however you want to do it. Basically, I have no borrowing on my commercial side. So they basically don't have, except I have performance on the commercial side where I have executed a few $100,000 worth of export orders. But the credit rating is high risk, and I don't understand where they get the high risk from. But I don't want to go into a side discussion. So basically we can talk about it. But I just wanted to pop it up because there might be others who are facing the similar situation or something.
Yeah, maybe, yeah, you, Rob, and I can do a quick little chat or something after.
All right, great. Thank you.
Thank you for bringing it up. Yeah.
Jim just had a question, and maybe this is for a sidebar too. He wanted you to explain the alternative for the VA qualification. And if that's
You got it. That's a, thank you. I didn't mean to cut you off, Sarah. Go ahead.
That's okay. No, if now is a good time. If not, we can move along.
Yeah, we'll definitely do that on the side. That's more of a personal home financing situation.
Okay.
I'm more than happy to talk about that as well after, with regards to getting a VA type of a loan without any overlays or policies. It's a great question. Okay, so this is the meat and potatoes, I call it. How is your credit score calculated? I don't expect anybody to answer that. It's kind of rhetorical. Is there a formula that a consumer can use? What if there is? Wouldn't that be great? There is. And do you have the power to change your credit score? Do we have the power to do this? Well, if we can make it go down, we can make it go up. That's my thought. All right, so here is one of the things you can find everywhere on the internet. What goes into calculating that score? How did you get to that 3-digit number? So this chart, feel free to grab it. You can also Google it. It's everywhere. I could give credit to a dozen websites for a chart just like this. When you get your credit score, 35% of it is your payment history. So you can pay everything on time, all the time. And it will count 35% towards your final score for that month. And 30% of it is amounts owed. But that's a tricky, that's like partial information. Amounts owed. It doesn't say relative to the amount that you were given, which we'll talk about in just a sec. 10% new credit. Okay, I have new credit. My score should go up. No, 10% of your new credit is contributing to your score. 15%, the length of your credit history is contributing towards your score, and 10% of your credit mix is contributing towards your score. So these are all contributions towards your score. And I'll leave the slide up there for a second so you can screen grab it unless you want to Google it.
Hey, Kim, what is a credit mix? What does that mean?
Oh, thank you. That's a great question. So credit mix is the type of credit that you have. So the type of credit that you have. So thank you, Rob. Did you see my next screen? There are several different types of credit. Thank you, Rob, for the segue. You have revolving credit. Does anybody want to take a stab on what revolving credit is? No? All right, I'll keep moving because we're gonna run out of time here. I just noticed the time. All right, revolving credit is something that you can use. It's a line of credit or a credit card, something where they give you a limit. They say, hey, we're going to give you this much money that you can use at your leisure as long as you pay it back at a minimum each month until you max it out, and then you're in trouble. So credit cards, charge accounts, lines of credit, which could include a home equity line of credit. That's revolving credit. So it's like a revolving door. You go in to think of it as a building. You go in through that little revolving door. You take a bunch of money. You walk out with that bunch of money. You walk back in. You pay that money back. You leave. You don't need it for a little bit. You go back in through that revolving door. You grab more money. You go out. You go back in, and you can just keep using that line of credit. You can pay it back, keep using it. That's a revolving line of credit. For business people, self-employed, starting out business, having available revolving credit is vital. It also makes up the largest percentage of evaluating your credit scores, which we will touch on because that information is not what's out there, and it is part of the most valuable part of this content. Okay, installment. So revolving credit, the comment I have here, these are the builders and the breakers. So revolving credit is the #1 way to build your credit. It is also the fastest way to break your credit. So it is the biggest, baddest thing on your credit report. Okay, installment loans. What's an installment loan? An example of an installment loan. Anybody want to take a stab?
Mortgage.
A mortgage is an installment loan, yes. Anybody have a car payment?
Car payment.
Car payments, installment loan. That's an agreed amount of money. It's oftentimes collateralized, means you're offering the car as collateral. So the car is actually, if you don't pay that installment loan, they're going to come take the car. You don't pay that mortgage, they're going to come take the house. So it's usually collateralized. However, you can have an uncollateralized, it's called a personal note or a personal loan. And that's when you go in and they say, hey, you've got a good profile. Here's whatever money you want, and you're going to pay us back over XYZ number of months at XYZ rate. You make the payment every single month on time, and eventually you've paid back the entire loan plus the interest. That's called amortized. So when you have a loan where there's a specific balance, every payment includes principal and interest. So you're paying back the money you borrowed plus the interest rate. You're amortizing that loan. And at the end of the term, 5 years, 10 years on a mortgage, oftentimes 30, that loan will be paid in full. That's called amortization. And somebody told me many, many years ago, just think of hammer time, amortize. And that way you'll say it properly every time. Charge accounts. Now, these I call asteroids because they can zing your credit like you wouldn't believe. Does anybody want to take a guess on what a charge account is? Because there are a lot of charge accounts out there that are not credit cards. Does anybody remember the Sears card? Or have a store card? The one I see Victoria's Secret probably more than anything on my credit reports. But if you've ever gone to a store and they say, hey, you want to save 10 or 20% today? And you give them your social right there at the cash register, you got a charge account with that store. That is not a credit card. It's a charge account, and they are asteroids. They are graded more heavily on your credit report. They also have lower credit limits than almost all the other kinds of credit. And so they are actually going to impact your credit more than you would guess. So my general advice is avoid those store cards at all costs. So if your card is for a specific entity and it's through them, that's a charge account. You're charging stuff to that credit, and then it looks like a credit card, but it's not. It's actually a charge account, and it is graded differently on your report. Student loans. Oh, I have a question from Jim. Oh, you have to unmute.
Push that button. So a store card that is a Visa card or something, that's not what you're calling a store card then?
No, that's a credit card.
Yeah, you're talking about the cards that are not Visa or MasterCard.
That's right.
Yeah, okay. Thank you.
They're very dangerous. No offense, stores, but they're dangerous. Okay, student loans. These are kind of loose wheels out there. Student loans do appear very differently depending on the student loans. Student loans are not really something that will build your credit, but they're not also something that can truly damage your credit. That's a myth I want to bust. A lot of people think their student loans are what's causing their credit to decline, only if they're not paying them. And then secured credit. And for those who are looking to really establish credit, they don't have a credit card, they don't have any prior credit history, and reporting those non-traditional is just too taxing. What you would look at is secured credit. The one caveat to this, very important, is if you go to get secured credit, you want to try to get secured credit card or a credit rebuilder credit card. If you get a secured credit installment loan, which is a specific amount you pay, that will not grow your credit the way that you want it to. It should be a secured credit or credit rebuilder credit card so that you are building that credit.
Kim, can I ask you a question on the student loan?
Yep, you sure can.
So is that only the federal loans, or is that like if I'm paying a private institute student loan back? You had made a comment earlier that a lot of the private institutes don't actually report credit.
That is a great point. So there's several different ways to borrow money to go to school. So you have your federal student loans. Those get reported, and they stay on your credit report, I mean, forever. The minute you get the loan, even if they're not disbursing the money, the loan is there. The other thing that happens on pretty much all the student loans is while you're not required to pay, whether you're in school or you have a deferral, the interest is accumulating on those loans. So what does happen oftentimes is the high credit limit that we see on your credit report and the balance don't actually match. The balance is higher than what you borrowed because that interest is accumulating. With regards to if you are on a payment plan with the school, let's say you got not a loan through the school, but not something that's falling under the category of a government student loan or a private student loan. So there's some banks and credit card companies now that do private student loans. Those all report because those entities report. But if you actually got a special circumstance through the financial aid department at your college or university, and you're paying them directly, like you're actually paying the college instead of a credit agency, they may not be reporting those student loans. You may be on a payment plan with that college that they've made an arrangement with you because of your circumstances where you're paying them back directly. And those don't report.
Okay.
Unless you mess up.
All right. And I have one question on the revolving credit. Is it bad to have them? Like, I know a lot of people who have a home equity loan that have never used it. Is that a negative?
So a home equity loan would be a fixed interest rate, fixed period of time. A home equity line of credit sitting there with a zero balance in and of itself, not bad, not going to impact the credit at all. No activity, nothing to grade, no ticks on your little wheel. So it's just sitting there. The difference comes when the rest of the credit report, whatever's happening over there, and this is sitting here doing nothing, this is going to affect the credit score more than that home equity line sitting there. Okay. But yeah, if you've got, at that point, that's where your installment loan is your stabilizer. So those installment loans are going to stabilize your score. Your score is going to sit here. If you're not doing anything with that home equity line, nothing's going to move because you've got stable. But those installment loans won't grow your credit. You can pay on them for a very, very, very long time, and your credit score is not going to climb. It's just going to, it might inch up, but if there's no other activity, there's nothing to grade, so nothing moves.
Okay. All right. Thank you.
Yeah, you bet. And actually, we're going to get into that a little bit more. This is the real meat and potatoes of it. So one thing that is not out there on the internet is that each trade line is evaluated and the entire report is evaluated. Now, what does that mean? So when you get a credit report and you have all your creditors on there, each creditor, an algorithm is run and that trade line or credit line is scored. They then take the entire, they do that for every trade line. They then take the whole report and they score it as well, which means revolving credit can actually account for 60 to 65% of your total credit score. So if you have a revolving credit, like a credit card, that's the biggest one we see is credit cards. That credit card can impact your credit score twice every time your credit is evaluated, which is once a month on a schedule. So if you have a credit card that gets, the algorithm doesn't like how it's getting managed, you can affect your credit score dramatically and quickly, even if you think you're doing the right thing. And this ties into some of the things that were brought up earlier. So you really have to be very aware of the revolving credit that you have on your credit report. And that's your credit cards and your charge accounts and your lines of credit. Anything that's revolving that you can keep using, it's very important to manage those. And that's how you grow your credit, is by managing those. And we are going to get into that. So, oh, we already covered this. Okay, so here is the formula for success on your revolving credit. And this is the information that is not out on the internet and very, very hard to find. There are no charts on the internet about these formulas. I've developed this over many, many, many years of testing it, not only with my own personal credit, but also through computer programs and software that I have access to as a lender, as well as doing it with clients for many, many years. Okay, so the revolving credit piece of it. When you get revolving credit, you're given a credit limit, right? That's how much you can use. So when you go and you get that credit card, they say, congratulations, you've been approved. You have a $3,000 line of credit. So we're going to use 3,000 as our example. If you put more than 51% on that credit card, your score will decline. If you got that credit card recently, within the last 6 months, and you went over that 51%, your score will decline immediately. So if you got revolving credit, and especially if you got a couple revolving credits, a lot of times when people get a credit card, they get a couple of them at a time. If you go out and you charge 51% of that limit on the card, especially when you first got it, because remember that length of credit history was in the calculation. This is the second part they don't tell you out there. Your score will drop quickly, dramatically, and immediately. So the fastest decline I've ever seen is somebody who gets a credit card at a store. This is why when you walk around stores and they offer you 10 and 20% off, I highly caution people to do that, because what they're going to do is they're going to open that line of credit or credit card or charge account. They're not going to tell you your limit, and they're going to put your entire purchase on the card immediately. And you've had an inquiry. So right out of the gate, your credit app on your phone is going to blow up saying your credit just tanked. So if you've gone out and you've gotten a lot of new credit recently, and you've used it and you've gone over 50% on any one of those, your score would have declined for that one trade line. If you went out, and especially if you also had other credit that was over 50% used. The other thing is it's going to impact you a second time, because it's going to hit the trade line, and it's going to happen again when they do the whole report. And so you get double the decline. You also get double the increase when you do it right. So it is equal. Okay, 50%, literally, if you stop at 50%, bam, 49.99999, your score will stabilize. There will be no change. You still don't want to do that on a brand new card though. Older cards. So if you have an old card, 5, 10 years old card, and you have 50% of the limit used on that card, your score will stabilize. There will be no change. When the algorithm goes through, they'll say, oh, he's under 50%, no score. He made his payment on time. He paid his interest back, no principal, no change. You get no ticks. So there's no ticks up, there's no ticks down. It's going to stabilize the score, each trade line and the report. So when you look at your credit cards and you look at your available limits, look at each one and then add it all up. How much available credit do you have and how much do you owe? If you owe 50% or more, you're at risk of your score going down next month for the whole report. If you owe 50% or more on any one, that credit line is going to cause a couple of ticks down. Now, you might have another credit card down there that's at 20%. That's going to go tick, tick, tick back up. So you might not see a change because those two cards are balancing them. But if you want your score to go up, 30% of your limit is where you want to be, or less. Any questions? That's a lot. That was a lot of info. Yes, Sarah.
I have a question, or actually Rosemary has a question. She uses her credit card to buy gas and groceries and pays it off every month. She carefully manages that. Does it make sense to spend the same over 2 cards and pay every month instead of 1? Do you understand? Does that make
Yeah.
sense?
I believe it does. So we have 2 cards. Are you using both cards for gas and groceries, or just one and paying the one off every month?
Okay, this is Rosemary. I am spending right now, I'm just using just the one card, and I am probably, somewhere around 20% of my limit. So
Okay.
would it make sense to spread that over 2 cards?
Yes and no. So you're in a routine and you're not going over 30%.
Well,
So,
sometimes I do, but I try not to.
Oh, okay. This is always the fun. So I told Rob, I'm like, I can spend like an hour on just this slide. Okay, so first thing I want to address is the last sentence on this. 0 balances result in no activity, no change. So if you're paying that credit card off every single month, your score is staying the same or stabilized is what we would call it. So if you have excellent credit and you're paying it off every month, that's great because you already have excellent credit. You're fine. You're in the open. If your credit is lower and you're trying to grow your credit, so if you're below, if you're below 740, I mean, once you get above 740, you're all set. So let's say you're at 700 and you want to get to 740. If you're paying that off every month, if those are the only trade lines you have, if those are the only 2 things showing up on your credit report, if you pay that off every month to a 0 balance, there's no ticks. That little music wheel is going around and there's nothing to grade. So it just smooths right on by. So there's no tick up. There's no blinking and giving you points for paying on time or not having a balance. There's nothing to grade. It's like having no homework. There's nothing to grade. So if you're paying off the 1 card every single month and you're only using the 1 card every single month, you're not going to see much of a change, if at all, to your credit score if there was nothing else on your credit report. Now, on the months that you might be going over 30% of it, then yes, then what you would do is also use the other credit card so that you're staying at that 30% mark if your goal is to grow your credit. Or if you happen to just have that 1 card and you do go over the 30%, when you pay, get it back down to that 10% or between 10 and 30% as soon as possible. If you go over the 30% and then you pay it down to 0, you're not going to get as much of a bump. You would actually do better to pay it to, like, if you go over 30, to pay it down to 10 and then pay it off the next month. So if you pay it off every couple of months, and you're showing that you're using the card, paying on time, paying back money that you used, paying back some of that revolving line of credit, you're going to get 3 ticks because you used it, you paid it on time, you paid back principal. So you're now managing your credit. And so you actually get more bumps or more ticks by doing it that way than by paying off to 0 balance. And I can tell you a really quick little story. I just did a mortgage for a young couple. And I specifically said, and they were on the threshold. So they were a 100% first-time home buyer financing program. And the minimum credit score for that program was 680, which means they had to have a 680 in order to get that loan, which was 100% financing. And I specifically had said, do not pay anything off. You guys are literally on the threshold. Yep, she paid off all her credit cards. And so, yep, I see Rob going like, oh my God. She paid off all her credit cards. And then when they got under agreement, they had an extended closing because the sellers they wanted time to move. That's how we got our offer accepted in this crazy market. And when we repulled her credit, guess what her score was? Yes, it was 679. Yes. Fortunately, I have every program in the book and I was able to move them into another 100% financing program and they closed Friday. So we're very excited about that. But she paid off all of her credit cards and her score went down.
That is so counterintuitive.
It is. Rosemary, I'm sorry, I didn't mean to cut you off.
No. Yeah, shock. Shock.
I was not
Thank
shocked.
you.
When she told me she paid off all her credit cards, my heart sunk. 20 years, my heart still sunk. I was like, oh gosh, here we go. Get ready. I'm gonna be working 7 days a week until this closes. Okay.
So why did it go down? I look at your lines here, Kim, and it doesn't say why it would go down if I paid it off.
So because she had zero balance, because she paid all of her credit cards off, she has, obviously there's other things on your credit report, right? Because remember, the whole report still gets graded. So what happened was, because she paid those off, there was nothing to evaluate. So there was nothing to stabilize the score.
Okay.
And she had something else that,
Okay.
right? She paid
Yep.
all but the one that was maxed out
Okay.
off.
Yep.
So she had one, right? She took all her money and she just paid them all off. I was like, oh
Yep.
my gosh, you're buying a house. Don't use your savings. But yeah, and so the score went down and it went to 679. Yeah.
Okay. I get that.
It is very counterintuitive. And this is the chart that's not out there on the internet, which is why I want to spend as much time as we need with this formula, because it really is the meat and potatoes of your credit. And it really will grow your credit quickly if you really start tackling, like really hitting it with this formula for your revolving credit specifically. Because even with the chart before, with the 10% and the 35%, it tells you it's credit history and credit profile and credit mix and length. But what they don't tell you is that the revolving credit is really what they're applying that formula to. And what they're not telling you is the 30-50 rule. So again, if you have a zero balance, it's not going to change. If you have an installment loan, it's not really going to change. It's going to stabilize. So if you have excellent credit, you have a little bit more leeway with this stuff because you have those stabilizers that are there. So you can spend a little bit more on those limits because you're managing it. You've managed it to the point where you're already high. But if you have a lower credit score and you're also going over 50% on any one credit card or charge account or line of credit, that's going to deplete your score that month. And if you have a couple of them or more, then it's really going to start to decline your scores. And if those cards are new, it's going to be graded more heavily because that credit history comes into play. So I did do the next slide. This is the formula credit limit. So when you get your credit card statement this month, look at what your credit limit is. Look at what your balance is. And if you are above 30% and if you're looking to grow your credit, you need to get it down. If you're above 30%, but you're happy with your credit scores, you're still okay. So this is for growth. I think somebody had a question about growth earlier. Yes. So does anybody have any questions about that?
Just a time check, Kim. You've got 30 minutes left.
All right, we're going to start cranking. All right, so just to move through these very quickly, this is what a trade line looks on when we get a credit report. This is what we see as a lender. So this is an individual's trade line. No names or account numbers included. This is a revolving line of credit. This person is managing it well. So if she wants to increase the score, I already gave you the answer. What does she need to have? 1260 or less, 1200 to stabilize, and 2101 or more, and that's going to start lowering the score. Now, little trick of the trade here. Can you do something that might help you grow your credit score if you don't have the means to pay that balance down? Yes, you can call them and ask them to increase your limit. From that creditor. Do not go apply for credit cards everywhere. Call that creditor, see if they'll increase the limit. Little trick of the trade. Okay, when you go to tackle your credit, this is very important. When people tackle their credit, a lot of times they like to piecemeal it out. So if they have extra money, they take that extra money and they apply it to all their credit cards. Well, if all the credit cards are already over 50%, you're only you're still over 50%. The computer doesn't care if you're $10 over or $200 over, it's over 50, so you take the same hit. So generally speaking, if you have extra money to contribute towards your credit cards or your credit card debt, tackle the most attainable 50% mark possible. So take your limits, take your balances, and whichever's going to get you to the 50% mark, hit that one hard. Instead of taking 10, 10, 10, 20, 20, 20, and breaking it up between all your credit cards, take that chunk of money and put it to the one that's going to get closest or below that 50% mark, because now you've stopped the bleeding for that one trade line and you've now stabilized that trade line. That's one of the fastest ways to really start tackling it instead of piecemealing it. I hear all the time, I've been paying a little bit on all my cards, my credit score keeps going down. And that's because they're all still over the threshold. So you have to get at least one of them down. Hit that one hard, any extra money that you have, and tackle it first. The second part of that is take a look, and I do have other workshops. I don't know if if we'll be doing them, but I do one on budgeting. Take a look at that bank statement and ask yourself, am I buying stuff that I want or is really convenient? Or am I buying stuff that I really need, like food on the table? Because most people have money in their budget that they're using for convenience. And sometimes just tweaking that a little bit gives you the extra money you need to really start tackling those trade lines. The other thing I want to tackle is balance transfers. Huge caution on balance transfers. People love, it's 0% interest. This is something people do on principle. On principle, they don't want to pay interest anymore on the credit card. So they go out and they do a balance transfer. Well, what did we just talk about earlier? An inquiry and going over 50% of the limit and your scores plummet. That's what a balance transfer does. So when you get those 0% credit cards for you to transfer your balance, sure, you might save a little bit of money on interest that time for that card, but all your other interest rates are going to skyrocket and your ability to get credit is going to be gone because the credit score is going to plummet. So the balance transfers, you would only do that if they give you enough credit to balance transfer and you're under 50%, ideally no more than 30 on that balance transfer. And that's rare. Usually the credit limit they give you, you're looking to transfer to get out from under a high balance, and that's when your credit is going to be impacted the most negatively. Also, inquiries. Who's heard inquiries hurts their credit score? Pretty much everyone, right? What is there a difference between a hard pull and a soft pull? So hard pull and soft pull is kind of lingo. When we get a credit report, there's no hard or soft or anything like that. It's being pulled for a purpose. So it's the purpose that impacts that inquiry more than anything. A hard pull, you might say for a mortgage, you're going to have a hard pull. It's actually a financial inquiry. So it actually impacts your score less than a credit card inquiry. It also is protected by several regulations, especially here in Massachusetts. So if you do pull your credit for a mortgage, you can actually have your credit pulled for another 2 weeks without it impacting the score at all. The inquiries won't count. You're actually encouraged to shop for that mortgage. And so you can no longer impact the credit. A credit card or a charge account, very different. The hit will be greater and you'll get hit every single time that you do it. So if you're walking around, giving your social security number out for credit cards, lines of credit, your score is going to go down because it means you're looking for credit. You're looking to borrow money. It's not going to be secured. And so every one of those hits is actually going to hurt. Because and also too, the approvals take time. So they don't know if you got other credits. So they lower your credit score to increase the risk to those second and third and fourth applications that you're putting in. So you don't actually get over credited. And I definitely want to touch on co-signing. Has anybody been asked to co-sign? Student loans is a big one. Car loans, right? For youth, right? So co-signing, I understand we all have people we want to help and co-sign for, and we want to support and save them money on interest. But co-signing has very long, has a long-term impact, especially on student loans. And oftentimes the cosigner forgets to follow up on whether or not that bill is paid. So I've had multimillionaires come in my office. They've co-signed for their daughter's loan or their daughter or son's loan and not be able to get a home loan. Multi-millionaires with strong income, and they can't get a loan because, you know, the person they co-signed for didn't pay. Okay, we kind of touched on inquiries. Does anybody have any more questions on inquiries? Okay, as far as hiccups that can happen to your credit, somebody asked, how do you recover from a hiccup? So does anybody have any specific questions about hiccups? I don't see any. So with regards to payments, so late payments are a good 30%. Late payments on credit cards, huge. Late payments on an installment loan will hit you. Late payment on a credit cards will absolutely reduce the score. I've seen 100-point hits on credit cards. So whatever you can do to ensure that your payments are on time. One of the things that I can certainly stress is if you've set yourself up on automatic bill payer, still check. If anybody has ever had technology fail, you don't want to find out a month after it failed making your payment, especially on a mortgage. Because the credit bureaus will not go back and fix that. Technology failure is not a reason for the credit bureaus to rescore if technology failed. So if the number one late payment that I see is people who set something up on an automatic bill payer and didn't make sure it did actually get paid, and they find out later when it's too late. So just be sure to follow up on those payments. The other thing is a lot of times people pay, you know, at the end of the grace period. That is actually affecting your credit. You want to pay on or before the date that it's due. This also saves you money in interest, because if you're borrowing money and you owe, it's accumulating on that balance every day. So when you actually let that go late, that interest is still accumulating and the balance is higher. So whatever you can do to pay on time or slightly ahead of time, that's going to continue to grow your credit. And especially in the commercial industry, this comes up in the commercial industry. In the personal industry, you kind of get that 30-day little grace period before anybody reports. But in the commercial industry, they actually track it more regularly as far as whether or not you're paying on time or ahead of time when they're looking to make a commercial loan. And then public records. If you've had a public record, we see things like judgments, bankruptcies, rents, right, leases that show up on public records. Once you have that satisfied and the docket's been recorded, you want to make sure that that's been satisfied and that the satisfaction gets reported, because the judgment will get reported, the resolution will not. So you have to be the one to report your resolution. It will oftentimes not get reported, and this is for all public records. Okay. And then as far as commercial, we touched on this earlier with regards to commercial credit. Commercial credit is based on the project. Personal credit is based on your ability to repay as far as borrowing money. So it's a kind of a big transition there from all the credit stuff before, looking at the time. So with regards to commercial credit, the project has to be able to be sustainable. And with personal credit, it's really your ability to pay that determines how much and what they're going to be able to give you. Does anybody have any questions? I know we just made a big transition, so that was kind of like a big switch. So before we do that, does anybody have any other questions about all that prior stuff we did about fixing your credit, rebuilding your credit? I see Sarah's hand.
I just have a little suggestion. When on occasion I've been hit with a late fee for a card that maybe I've had for a long time, feel free to call them and ask them to remove it. 9 times out of 10 they will. And does that get recorded as not a late fee? I mean, does that, you know what I'm saying? Like, it's on there. I call them and say, I'm sorry, might give them some excuse. And they're like, oh, we'll be happy to remove that.
I'm so glad you brought that up. So with regards to lates, I almost don't want to share. So lates are calculated on 30-day periods. So what the credit card is, what the company is asking for a fee versus the reporting of the late to the credit bureau are two totally different things, and they actually don't talk to each other.
Of course they
So
don't.
yeah, no, they don't. So the late fee doesn't, unless you don't pay it, then it gets recorded. But if you've incurred a late fee, yes, absolutely call them and say, hey, and try to get that late fee removed. Keep in mind, they're not reporting that you went late until the next payment is due and you haven't paid.
Right.
That's called a 30-day. So it's a very dangerous game to play. I don't advise anybody to do it. On time and early is always the best, but you do have roughly 25 days, 25 days to catch up to that payment. The fee itself won't get reported, and the late actually won't get reported until the next bill is due and you haven't paid on that. So thank you for bringing that up. The other suggestion too about credit card companies is you can, even though you don't want to balance transfer because it's very dangerous, you can certainly call your credit card company and let them know you're being offered a 0% interest rate, and tell them you're going to leave unless they lower your interest rate. So that's another little credit card trick. So a lot of times when you go over 50% of the limit on your credit cards, all of a sudden your bill goes up. You don't know why. It's because there's this tiny little print on the third page of this tiny little disclosure they send you once a year that says if you go over 50% of the limit, your interest rate's going to jump to this amount in the 20s, oftentimes 23 to 28%. Your credit cards, the interest rate will jump once you go over 50% of the limit. Well, call them up, because it's very hard to get out from under that. Call them up, threaten to leave, tell them you're getting a 0% offer, you're just going to transfer your whole balance out of there. And oftentimes they will reduce the interest rate on the card. They may not go back to that introductory rate, but you can save quite a bit of money on the interest.
Okay.
Which might make that
also has a question. He wants to know if it's true that public records and such get deleted every 7 years.
So yes and no. It ties back to that same philosophy. If it was negative, it got reported, but oftentimes it's up to you if there's been a positive resolution to report it.
Yeah.
So on a bankruptcy, so big credit decisions like a bankruptcy or a foreclosure, a judgment, those oftentimes, so a judgment, once it's resolved, you can sometimes get it off. It does depend on the category. A major credit decision like a bankruptcy or a foreclosure, the foreclosure will stay there because there was a creditor associated with it. The bankruptcy, that falls under public records, and after, it is going to be there at least for 7 years. Generally speaking, it's 10. And generally speaking, you do have to write in order to have it removed. And child support will stay there until the entire balance is satisfied, which means it's a long time.
Kim, can I ask a scenario that I see happening all the time, or see it advertised? I go to a furniture store and I want to buy $5,000 worth of furniture, and they say, fine, you can not pay for 3 years. What impact does something like that have on my credit?
So that's a great question. We see this more and more, especially as items become higher priced, higher ticket priced items, especially furniture, appliances, and even now phones. So as long as they give you an available line of credit that's 50% of more of how much you're going to use, that is a great option. It is actually a line of credit with the store. It does get reported. It is being financed. So those stores, so, you know, just to name a couple big box stores like Bob's Furniture, Bernie and Phil's, right? Those are the big furniture places. But they do it differently. Like Best Buy, that's through credit. I think it's now, it might be Citi now. So some stores use a credit card company to do the financing, and some actually have like a financial or financing service. And some of it, it's their own. So as long as they give you enough to get what you need without going over that 50% mark, that's great. And then you have 3 years to pay it back at 0% interest. You know, it's one of the ways the stores have found a way to increase the ticket price or the sales price, right? Their revenue, because they're the ones actually giving the financing. They're getting the money either way. So they'd rather have that price today and have you not pay interest on it than lose the sale.
But most of them don't tell you what your max credit is. They just say, you know, fine, we'll open this up and we'll put this on your credit. So I wonder, how do you find, you know, are you at that 50% or not?
Yeah, so you have to ask. And sometimes they can tell you and sometimes they can't. They see on their screen, right? And oftentimes you're talking to, you know, a clerk or something. This is not a credit decision maker that you're talking to. You're talking to the in-between, right? So sometimes they can't tell you how much that credit line is. So if you are going to do that, yes, there's an advantage to it because of the 0% interest. If they cannot tell you how much they're going to give you, you really want to make sure that you've got some reserves on the side, especially if you need your credit score to continue to stay high, right? If you know you're going to need something in the next couple of months and you need that score to be high, you need to be able to find out very, very quickly and pay that under the 50%. Otherwise, you're going to get that double ding that we talked about earlier. But yeah, those are great programs as long as they give you more than enough.
Okay. All right.
Yep. That is true with the home equity line of credit as well. Okay. So with regards to how they're evaluating it, I know this is something that you talk about a lot over there, are the 5 C's of credit. This is not a common term. It's not common knowledge. Even people in the lending industry don't bring up the 5 C's a lot. But whether you're looking for commercial credit or personal credit, the 5 C's of credit are part of the credit decision. So a lot of loan officers won't talk about this, but the underwriters are definitely going through a checklist. So character is your reputation. So do you have a reputation? Is your business or your personal profile the character with which that you would pay this? The capacity means that you have basically the ability to repay it. Do you have the capacity to make this payment every single month based on your finances, based on the money you have coming in, or based on the project profitability projections? Collateral, that's when you're going to secure that loan with something of value, right? So a car loan is a collateral loan. So you're going to give them the car, you're going to secure the loan with the car. If you don't pay it, like I said earlier, they're going to come take it. And that repossession will go on your credit and it will stay there forever. It may go down further and further on the credit report, but if you've ever had a car repossessed, it will be there. And if they sold the car at auction and they got less than you owe, they can still come after you for the difference. So you very much want to be aware of that stuff. Capital is, of course, the money you have. So years ago, we used to be able to write loans based on somebody's capital. So if they had a lot of money in the bank, we could give them a loan because they had a lot of money in the bank. And this is something you probably hear in small business as well. Is I have all this money in the bank. I mean, I could buy this cash. Why can't I get a loan? I actually just heard that this week. I could buy this cash. Why is it so hard to get a loan? Because you have to have all of them, right? So it's not one characteristic that's going to put you over the top. It's the combination of the 5 C's that get you over the out of the starting gate. Same thing with the credit scores we were talking about before. The credit score is the starting point. It allows you to proceed to see if you can get the loan. capital is just a factor. If you have capital, it is going to strengthen your profile. Your risk factor is going to be lower if you have a bunch of money in the bank because you're able to save while also paying your bills. And then the conditions, are the conditions right for this? So, we ran into this, especially in the last 2 years, personally and commercially, where the conditions were great. We went from, business booming, everything on the rise, into a pandemic. So credit decisions over the last 2 years have changed dramatically because of the conditions. Does anybody have any questions about that? And I did see something pop up in the chat. I didn't quite see the question.
Vanessa had a question about medical bills. I don't know if that's a whole nother topic. And Dee wanted to know how she can report someone that owes her money.
Ooh, okay.
And I know we're sort of pressed for time, so.
I know, 8 minutes. All right, so very quick. So Vanessa, on the medical bills, somebody asked about this, Vanessa, I think it was you. Medical bills are reported. They do go on your credit nowadays, and they can impact your credit score. They are an item that's reported to collections. Most oftentimes, it's when your medical facility has sold it to a collector. So the medical facility did not report it. They sold the debt. They wrote the debt off. It could also be called a charge off. So you have a charge off for the debt from the medical place, but the collections company bought it for profit. And so now they're chasing you down to get it. And they're the ones that are attaching your credit report. In that, it is difficult. Medical bills are, they are really, and it's new. This was not true years ago, which is why the myth is out there that medical bills won't hurt your credit. They will. In some cases, you can start back at the medical facility that you got the bill from and see if they would be willing to do some type of a payment plan, but only if they've not charged it off. So the clock ticks on that. Once they've charged it off, you can't pay them because they got a tax advantage by filing that as a loss on their tax return, and then they sold it. You then have to deal with the collections company to do it. And what I can say there is going to tie back to what Sarah brought in earlier. You can negotiate with them. You could also go on a payment plan, or you can let it sit. The more collectors that buy it, the harder it is to prove you owe the debt. And you can always go back and fight it. So there are Fair Credit Reporting Act. It's very difficult. It's very time consuming. I will absolutely acknowledge that. But you can go back and dispute it, but you need to do it. If you do the credit bureaus, they're just going to tell you disputed it, and you won't get much information. You have to go directly to the creditor and try to dispute it with them and record it all and document it all, and then go to the credit bureau with your result. With regards to somebody who owes you money, it depends on what they owe you for, how much you can prove, and whether or not it would exceed a small claims court type of filing. If it's under a certain amount, you'd be encouraged to go to small claims, which means you end up still having to go get it. If it's over a certain amount and you can document it, you would be best to discuss it with an attorney. Does that answer the question? We kind of fast. So this is the Dun & Bradstreet link that I will send out for those looking for that. And it is true, it is very difficult. Most of it starts with personal. I wanted to bring up, if you're starting a small business and you don't have a commercial credit, a lot of people will opt to get a personal line of credit. If you have a home, you can use your home to leverage it and take a home equity line of credit. The big thing about that is you want to be very aware of how much you're borrowing and your ability to repay it back, because at that point the bank has approved you for it, but you're still the one who's going to be paying on the home equity line of credit from your business. Hopefully your profitable, successful business going forward. We did kind of touch on the resources as far as getting your credit. Does anybody have any questions about any of these? Are kind of some of the hotter topics out there today. No. The big thing I would say is, as far as credit score goes, I do not work for them. I did work for them. I no longer work for them. We had a great time. DCU religiously, they offer a free FICO score service for people who do bill pay or have a checking account. In 20 years, it's the only source that has matched the credit scores that we pull. It's through Equifax, and it's free. The rest of them charge money, and you're going to be working with an alternative credit score like a consumer, a Vantage, or one of the consumer scores. So if you really do want to monitor your credit, DCU is actually the best. If you're going to use some other service, oftentimes they charge money. And what you're going to want to pay attention to is the trend. The score itself may not be accurate, but the trend will be. The other thing that I want to note about all of these other things, they're telling you all the time your scores are being evaluated. This came up earlier. That's actually not the case. Your scores are really only changing when they're pulled, and once a month it's evaluated. So if you're getting hit every day, every other day from your app saying your scores changed, it didn't actually. They've just received information and they want you to tap your phone. Your scores are really only evaluated once a month on a regular schedule, or when you're inquiring about credit. They're not actually changing every day. So if you're getting those pop-ups, that's just more of a click and look.
Kim, Sasha wants to know if it's worth a shot to try and open a business account with a current business credit card that she has. Is that right?
The question
Sasha,
actually is, should she use her personal account or open a business account when you're opening a business, when talking about credit cards? Or is there a difference?
So yes, there is a difference. So a business is going to have a credit card in the business name. Personal is obviously personal. When you do it in a business name, depending on the strength of your current profile, you may have to personally guarantee the card anyway. But generally speaking, if you are going to do it for a business and you have all of the business numbers in line, yes, you would want to separate the business from the personal if you have the ability to do that, yes. And then you want to make sure you really only use it for business, because that's the other hang up that we see. I'm not a tax attorney or a tax accountant, and I cannot provide you any advice on that. There's my disclaimer as a loan officer. Anything tax related, you want to talk to your tax accountant, tax preparer, or tax attorney. But I can say you do want to keep those things separate.
Vanessa, your hand is raised. You want to go ahead?
Yes. Is it a good idea to have all your assets, like having your house, your car under your business name, like and get the credit from that, and or build your business credit from that?
So if I understand correctly, would it make sense to have all, your house, your car, and all of that associated to the business?
Yes, and put them under your business. Like, let's say you have an LLC, and then you say, okay, I'm gonna put my car, I'm gonna put my my house, I'm gonna put whatever assets that you have under the business, and then like build your business credit, or having credit from that.
So I'm going to answer in a more general way, and I'm happy to talk with you at some point about more specifics, but generally speaking, the answer to that would be no. Generally speaking, you would start your business profile with a small footprint for business, and let that business footprint grow with your business credit. Your personal, you would want to keep that protected, especially your house. You wouldn't want any business debt to ever have a pathway to collect on a business debt, collect your personal items because of a business debt. Generally speaking, you'd want to keep them separate. Generally, you start with maybe a personal home equity line that you might use to do things for your business, but you're not tying that business to your personal things like your house or your car, things of importance, things that are necessities. You would want to keep those separate. And I'm happy to talk with you about that in more detail after, but yeah, you'd want to keep your personal life protected. And a businesses coming, we all want successfully huge, right? Businesses, we all want to see those grow. But the reality is not all businesses succeed. You still have to live.
And one more
That
quick
answer your
question.
Okay, and I had one more little slide I wanted to show.
Okay, go.
All right, here's the slide. So when I'm talking about growing your credit, this is an example of something that I did for a client. When I say you can seriously impact your credit overnight, I had a client who came to me in August of 2019 to buy a condo. Her dream condo hit the market, and at the time she did not qualify. We could not get her approved. This, I know it's very small, but you can see her credit scores were all below 700. 660 was her middle credit score, which is the one used for mortgages. In 9 days, she did have the means to tackle some of her revolving credit and the rest of her credit report. She sent all the information to me, and I did a rapid rescore for her. And on August 9th, 9 days later, her middle credit score went from a 662 to a 731, and she closed on that house less than 30 days later. So when I'm talking about the stuff that we do, it is dramatically, it can impact your credit quickly and dramatically if you follow the combinations that we shared today. And that can make, I lied, it's 2 slides. And that can make a tremendous difference on your interest rate when you do go to borrow money. Seeing as we were talking about lending and small business stuff, the middle column here, I'm going to highlight, I lied, it's 3 slides. The middle column here, you can see the difference in interest rate between a 640 and a 740 credit score. The difference in the payment is $350 per month for the exact same amount of money, and over 20 grand in 5 years. How much could 20 grand impact you or your business in a 5-year period? So getting that credit in line is vitally important in today's atmosphere. And then that was it.
Kim, go ahead and put up your slide with your information so if people want to get in touch with you.
Okay, so this is me. My first thing is I do mortgages. I help people buy and refinance their homes. And 20 years of that has just produced a lot of information about credit. I'm always happy to share. So if you know anybody looking to buy or refi,
right,
I'm your girl.
And you know, we do, when we talk to our clients, a lot of times we do suggest that they go with the home equity loan to help finance some of their business. It's a much more direct path to get money than to go down the commercial path to get money. So absolutely. So we can all go to Kim. She'll get you a home equity loan. And we go from there. All right.
I know we covered.
Go ahead, Sarah.
Oh,
yeah, I know we covered a lot, and I have a feeling, Kim, we'd love to have you back because I feel like this topic is very broad and we could go on for hours, which we don't have. So thank you. You did a fabulous job. As I said to everybody in the chat, I will send her information out again, a survey and our information from the Small Business Development Center, and any questions you have for myself, Rob, or Kim, we will be happy to answer.
Thank you so much for having me. I hope everybody enjoyed it as much as I enjoyed sharing it. And I hope you walked away with some valuable information to help you with your credit and your small business ventures.
Well, thank you, Kim. Thank you for sharing your information. All right. Thank you all for joining, and
thank you.
Hope to see you back soon.
Everybody have a great day and be safe in the snow.
Thanks. Take care.
Thank you.
Thank you.